Okay, so I'm carrying on. I'm continuing from where we left last time. And the last time we left was we were discussing about the price mechanism. And I think I discussed with you that there are two scissors. So price mechanism is like a scissors. You know scissors? Scissors. And scissors have two blades. The one blade is demand. The second blade is supply. Unless you have both blades, the scissor will not cut anything. It's a useless tool. So therefore, it's very important that the price mechanism to be applicable to come in action, it's very important that demand and supply, both blades are perfectly fine. None of them is rusty. If one of them is rusty, not working so well, the market mechanism will not function, and then we call such economy as an imperfectly functioning economy. Those economies where market is very active, their blades, both blades, demand and supply, are very sharp and rust-free. And those economies where the system has some loopholes, it's porous, it's inactive, they have some kind of imperfections, it means that one of the two blades or both are having some rust. We need to clean it. It can take centuries to clean it though. So there is demand and supply. Should I shut the door actually? Because I don't want to make you hate it. So you can see that we discussed last that demand is representation of inverse relationship between price and demand, whereas the supply is representation of a direct relationship between price and supply. And then we have some equilibrium. Demand and supply are. We have a demand price. Demand price is the price which the consumer wants to pay. This is the maximum price a consumer wants to pay. Supply price is the minimum price which a seller must receive. Now, I want to throw this question open to you. When I say demand price, it means this is the price which this is the maximum price which a consumer wants to pay. And supply price is the minimum price which a seller wants to receive. Does it make sense or not? So I'm using two extra phrases, maximum and minimum. I repeat, when I say demand, I say there is an inverse relationship between price and demand. I must add a suffix. No, it's not suffix, it's prefix. That demand price is the maximum price which a consumer wants to pay. And supply price is the minimum price which a supplier wants to receive. How does it go? Oh, that's a cue. So we start at 8:45, so the boarding is completed by 8:55, okay? Come in time. So when I say maximum price, it means that the consumer doesn't want to pay the minimum. Can you ask a consumer, hey, you know what? You want to buy this marker or this pen? The minimum price is €1. You can pay as much as you want on top of this. So are you joking? You will only say that the maximum price is 1. But if you are a supplier of this pen, you will say, you know what? The good news for you is that the maximum price of this pen is €1. As a seller, you would be awfully angry. What do you mean by it? I want to have a minimum guarantee. Whatever I get on top of it is a bonanza. is a jackpot, is my luck, my increased profit. So when you talk about the price from the consumer's point of view, always focus on maximum. But when you talk about the price from the seller's point of view, always keep in mind minimum. So it's maximum, minimax. So it goes like this, that whose perspective are you talking about? A consumer would like to pay on the minimum of all the maximum prices. You get my point? That's why you shop. That's why you do the window shopping. That's where the concept of window shopping comes. That the same quality of product you are shopping, you are just seeing in different shops, different stores. And when you see, okay, this is maximum, this is maximum, this is maximum, which is the minimum of the maximums, that's where you choose. And same way, as a supplier, what you do? You want to have the maximum strategy. You go and talk to different retail stores. What's the minimum price you pay me? And then you say, okay, I pay you 10 euros, I pay you 12, I pay you 15, and then you get the maximum of the minimums. So as a consumer, you apply minimax strategy. As a seller, you apply maximum strategy. Doesn't make sense? Minimax, maximum. As a consumer, you want to pick the price, you want to pay the price which is a minimum among the maximums. But as a seller, you want to charge the price which is the maximum among minimums. So the whole perspective is different. Anyways, so that's demand, that's supply. And then we have the equilibrium. That's where we have the equilibrium. And equilibrium is the word which we see 99.9% in the textbooks, but in economics or in finance or in business, it's very important that you enrich your vocabulary, the business vocabulary, and the other names for the equilibrium price could be notional price, natural price, okay, or what else we can call it? Yeah, equilibrium, natural, and notional price. So these are two more words for the equilibrium price, okay? And here you can see that Keynes at some stage talk about the invisible hand. If you look at all the classical economists, they are of the favor of the minimum state intervention in the economic affairs. As a matter of fact, if you look at the very pure capitalist theory, it says that the state should be a referee, not a player. Doesn't make sense. The whole economy is like a football pitch. All the consumers, producers, they are active players. All the entities, all the individuals who are taking part in the economic and business affairs are players. Of course, you can't have a game without a referee, can you? That would be a kind of, it will be very dangerous to play. I will not play, at least, even though I chose to be a football player yesterday for a change. I would never play a match if there is no referee. But the question is that who's a referee? A referee cannot be a player. If there's a player and the referee, so if one of the player is also a referee, what type of impartiality you can expect from him or her? Do you get my point? The question is that what is the role of state? And the role of state, according to the classical free market economist, is that the role of the state should be no more than a referee. The state should never be a player. So it means that the classical economists, they are of this favor, of this opinion, that state should not be an active role player. So can I ask you that in Finland, according to this Puritan, very pure school of classical capitalistic theory, do we have the capitalism? Can you call Finland a capitalistic society or a purely market-driven economy? if you go by this adage, this example of referee and player, can we say that Finland is a market economy? Yes. Yeah. So we just have a discussion that Finland cannot be called a pure market economy, because in Finland, state is a lawmaker, rule maker, policy maker, but at the same time, state is a very important actor on the economic spectrum. State invests in many companies, and many enterprises are fully owned by the state as well. Now the question, I repeat, is that if you have to name one country in the world which, according to you, is the purest form of market economy, which will be that? One country. Yes.
USA.
USA. Yeah. Apparently, when I think about the very strong capitalistic countries, very strongly free market oriented economy, I get two answers. The one is Great Britain. The second is USA. As a matter of fact, in Great Britain, state is very obvious in the economic affairs. In the US, you're perfectly right. But even, I think I use the phrase ironical, right? The irony is that even in the US, approximately 20% of the GDP is contributed by the state. So even in such a strongly capitalistic society, which is a kind of ethos of capitalism, the state is so active.
Companies have they can affect in politics as well. So
of course, yeah, that they can affect in Finland also. Yeah, yes. But as a state, as an active player, is very strong, even in the so-called capitalistic economy. Now, I was talking about, yes. Yeah, that's true. Yeah. Yesterday, as I said, that we invited some entrepreneurs. So we were having a lot of discussion about it, that which model, should we stick with this welfare state model, or should we go and become more, capitalistic? So there were different thoughts among the entrepreneurs. So they think so differently, even in the same industry, in the same sector. So you can't say that, okay, because we had this big entrepreneurs and the SMEs. So you can't say, I was trying to say who is in favor of very pure capitalism. There were some SME and there were some big companies who were saying, no, we go for more capitalism. I think we are a very restrained economy. And then the same group of people, some SME and some big companies were saying, no, don't do that. Don't do that. We are very happy with our welfare state model. So it's very difficult to make a conclusion that is it SME going for protection, or let's put it this way, the big company want to get more exposure? No, it's a very mixed response of companies. And I'm not saying about one or two companies. I'm talking about my discussion based with around 30 entrepreneurs. I can say that 20 were coming from so-called SMEs, and 10 were coming from the big giant companies, listed companies in Helsinki Stock Exchange. And they were divided. It was a completely divided house. No, no conclusion. Sometimes drawing no conclusion is better than drawing a conclusion, because that means that people are thinking. Okay. I was talking about the phrase invisibility. Economists say that the free market economy is a invisible hand. Have you seen Maradona's goal in 1982 World Cup? It's called God's golden hand. So that's an invisible hand. Many people say, actually, it looks like that he was actually not headed, but handed the ball, and the ball went to the Germany's net, and that was 2-1 in favor of. It was 86, actually, not 82, 86, yeah. Yeah. So there is an invisible hand here. The invisible hand here is that, if you see, this is a junction. This is a crossroad, and that's where demand and supply meet. And when the demand and supply meet, we have this equilibrium price. Equilibrium price is the ideal utopian price, that this should be the price in the market in a given situation. Now, I want to say a situation not when equilibrium price exists, but when equilibrium price does not exist. Now, imagine the price is not this, but price is here somewhere. The point is that the price should be this, where demand supply become same, equal, but the price is this. It means the price is overpriced. Okay, now if the price is this, and if you start measuring the length geometrically, the supply is this, sorry, the demand is this, yeah? If you draw this fictitious line from here to here, demand is this, but supply is from here to here. I repeat, the total supply at this price is this much, but total demand at this price is this to this. It means that this is called excess supply or surplus supply. When something is available in the market in surplus, what happens to the price? If there's too much, there's abundant of output. Let's say the demand is 10 kilos, but supply is 40 kilos. What happens to the price? Sorry? Very good. So what happens? Here is a natural justice. The price should have been this. The price is this, but on this price, as you said, there is much supply. Supply is more than demand. And when supply is more than demand, we call it excess of supply or deficit of demand. Demand, deficit, supply, excess. And when there is excess of supply, as you said rightly, the price will drop. The price will drop until they become equal and there is equilibrium. Here, who came? The market forces came. There was no state dictate. There was no state regulation that, hey, bring down the price. No way. It came through this invisible hand of capitalism. All right. On the contrary, the price should be this, but let's assume price is this. It means the product is underpriced. When the product is underpriced, what happens here? Supply is this much. See the cursor, I'm moving. The supply is this much, but demand is this much. It means there is excess of demand or there is deficit of supply. Now imagine a situation when there is too much of demand or too much scarcity of the product. What happens to the price? There's a long queue of people. There's a queue of people demanding the product, but supply is in shortage. What happens then? Say again? The price start going up. So what happens? The price start moving up until this anomaly, this gap is automatically reduced, and this is called price mechanism. Here, there is no man-made artificial government restriction coming in the picture. It's all done in the cloud. So the cloud computing has just come recently, but cloud economy is always there. That things are done in the cloud. Things are done automatically, spontaneously, organically, naturally. You don't have to make a change to the price. Things get determined so much spontaneously. And this is the beauty of capitalism. Capitalism is really beautiful, okay? Only it has some flaws, it has some limitations, but the problem is that if somebody asks you, oh yes, capitalism is a bad word, I think you as a student of economy, you should say that economic model is great, but don't forget that every model, every theory are having some limitations as well. So when you study a model, also study the limitations, the shortcomings. Okay? If there are some shortcomings appearing, that doesn't make the model useless. The only thing is that you have not studied the limitation, it's your problem. Okay, so people who talk about, oh yes, this school of thought is great, that school of thought is great, and they only talk about this and that, very convenient examples and very convenient arguments, I think they need to read first more than becoming judgmental. So this is how the price mechanism is determined. But here, I want to ask you that if you have any questions, because soon after this, I will show you a reality. But before I go to this reality, I want to ask you something. So here you can see that we have the demand curve and the supply curve. I hope you can see. And then we have the equilibrium price. But then I drew some prices, which I call as a maximum price, the consumer's price, and the minimum price as the producer's price. Remember, in any economy, now imagine, I want to make a picture in front of you. Imagine that the state is absolutely silent in the economic affairs. State plays no role in the economy. State says, hey, don't ask me for the price is going up, demand is going down, don't ask me anything. We are living in a free capitalistic society. I cannot interfere at all. Let the invisible hand play its role. Okay? Now, see, that is a backdrop. That is a background of this example. The price should be this much. Demand, supply. But what happened is that there are some economic disturbances. And as a result, the price is going up all the way. When the price is going up, who will be suffering? Consumers. Remember, we have two categories of economic players, consumers and producers. Do you think producers will be happy when the price is going up? Yeah. So I can say that consumers would be very angry. And then these consumers, angry consumers, they go and ask the prime minister of the country or the finance minister of the country, hey, what are you doing, mate? Look at the prices. The prices are going up. What are you doing? And he says, or she says, that, look, we are a capitalistic economy, nothing much I can do. Wait till, as Shab said in one of his lectures, go to the YouTube. He said in a lecture that when there's too much of prices, overpriced, demand will be less, supply will be much, the price will drop. Wait, show some patience, be good students. And the price never comes back. Price keeps rising. No, then the state must jump in the picture. Then, when the price is going beyond a certain range, the state must impose. I shouldn't say must, I shouldn't sound very moralistic, but the state can come in the picture. And then they can fix the price. That, hey, we don't care demand supply curve, the maximum price of this product would be this much. So even if the equilibrium price is here, we don't care. The maximum retail price or the maximum, in many countries, I think because you both come from India, and in the products, when you buy some product, it's always written MRP, which means maximum retail price is, let's say, 10 rupees. But that doesn't mean that the price is 10 rupees. The price can be 7. But 10 means that price would never be more than 10. Do you get my point? Let's say if I'm in India and I want to buy this pen, On this pen, it would be written the maximum retail price, which means this price is 10, let's say 10 rupees. But when I say, hey, the shopkeeper, you want 10 rupees? No, 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 I want 7 rupees. That is the equilibrium price, 7 rupees. 10 means that in no situation, the seller can charge more than 10. As a consumer, should I feel good about it? I think I should, because to me, it's a sense of relief that capitalism can be active between 7 to 10, but not beyond 10. Otherwise, it could be possible that the supply of these pens is reduced, demand is more. This could be 20, 30, 40, 50, endless. I'm harmed. As a consumer, my interests are harmed. So how the state protect the consumer's interest by fixing the maximum ceiling? So, all right, the price can go up from here to here to here to here, no problem. But no way the price would go beyond it. And if the price tries to go beyond it, the state would jump in the fray, and it gives no consideration to demand and supply curve at all. On the contrary, I haven't forgotten you. I'll come back to you because you raised hand. I'll come back to you. On the other hand, let's talk about the farmers. Remember, as a farmer, when you grow some crop, you don't grow the crop every day. There are certain seasons when the crop is ready. But the thing is that when the crop is ready and it comes in a glut in the markets are full of crops. On that day, when the crop is coming to the market, people will not start eating double, triple, 4 times, 5 times more. No, demand would be same. It means that there would be excess of supply over demand. All right. And the farmer, and when there's an excess of supply over demand, what happens to the price? Sorry? When there's an excess of supply over demand, what happens to the price? The price goes down. The farmers can be harmed. And look at the tragedy. If I don't talk about the farmer, I talk about this pen manufacturer, and supply is not suitable, sorry, the price is not good, you can go back home, reverse to your van, go back home, say, I'm not going to sell it. This luxury is not available to the farmer. Number one, the crop is too much, the crop is perishable, and the poor farmer may not have the storage facility. So in that case, the farmer has no option but to sell the product at a low price, which may not cover his cost. This is called distress sales. We use a phrase in economics, it's called distress sales, which means you have no option but to sell. Even at loss, sometimes you have to sell things. So when the farmer is in this situation, he will be selling at a distress price, distress sales. How to save the farmer in this case? The state says, hey, the equilibrium price is 10, but no way the farmer would get less than 8. If you get 8 and above, good for you, sell in the market. But if the price is below 8, the state is saying to the farmers as a guarantor, hey, then I would buy from you. If nobody's paying you 8 or more, not more, if nobody's paying you 8, this is 8, come to me and you can bring indefinite quantity, I would buy. This is the assurance by the state to the farmers. So this is a guarantee to the producers, and this is a guarantee to the consumers. It means in the normal circumstances, the price mechanism play a very active role in the society, in the economy. But in some rare circumstances, when the price is excessively high or price is hitting the rock bottom, in that case, the state can jump in the conclusion. And believe me, in most of the countries, this is what we do. Okay. Now, when you see this picture, can you call it a free market economy? Purely free market economy of the dreams of Adam Smith? No, no, you're right. This is called managed price mechanism. This is not free price mechanism. I would rather call it managed price mechanism, or even controlled price mechanism. Why it's controlled? Because it's not free. There is a freedom. Look at the cursor. There's a freedom for the price to go up from here to here. Price go up, 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 but not beyond this. Not beyond this. And the price can go down, 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 but not below this. This is where the state comes as in not only as a referee, but also as a player. Hey, I won't let the price go down below this point. Because if the price is going too high, the consumers would be very angry. The price is going too low, the producers would be very angry. So you make some kind of bridge between the two. And this is called controlled price mechanism or the managed price mechanism. And in most of the countries, we never see the 24-carat price mechanism that it can go anywhere. Right? Does it make sense? Right? You okay with this or not? So this is the managed price mechanism or controlled. Have a look at this for some time, and then the equilibrium itself is movable. It's never constant. For example, this is demand curve. And this is supply curve. Okay. It could be possible that there is a shift in the demand curve. There is a shift in the demand curve. Now I want to test your knowledge, how much you know. In what circumstances demand shifts? When does demand shifts? Let's say demand move from here to here. So you can see that the old demand curve is this, the new demand curve is this. Always come after studying in the class, okay? Normally I'm not angry if the student don't reply, but sometime I can be, especially in the morning time, yeah? So whenever there is a Wednesday lecture, always come after studying. Okay, I'm in a better mood on, am I recording it? Oh. Yes, so when does demand curve shift? Was it too much? Yes. Excellent, excellent. When the quantity demanded not rises because price falls. Because if the price falls, then there's no shift in the demand. Then you're moving along the demand curve. But if there's a change in wealth, people's income, taste changes, habits change, some cultural things transform, then the demand curve itself shifts. It can go up or down depending upon which way is the movement, yeah? But so in this case, there's a shift in the demand curve, okay? And if there's a shift in the supply curve also, so means supply curve is not this one, but this one, then the new equilibrium is no longer this. The new equilibrium is on new demand, which is this, new supply, this is the new equilibrium. So the equilibrium itself can change. So the equilibrium is not eternal. Equilibrium is not like some kind of divine, some spiritual words of some great sage. No, the equilibrium itself is changeable. Okay. Well, I'm coming to that point very fast when you will see that the equilibrium can change after every few seconds. right? But I'm coming to that point soon. Okay, does make sense? So the equilibrium can change. And in this example, the demand went up and supply also went up. But there can be a catastrophe when demand goes up and supply goes down. So what happened is that demand goes up, supply went up, but what if the supply goes down actually? That's bad. Demand goes from here to here, up, supply falls from here to here. Yeah, so it's a very dynamic situation. Demand supply can move regardless of being sensitive to each other. All right. So yeah. So coming back to, we'll have more discussion about this change or this shift. Okay. Oops. So where is the? Right. This is what we are doing now, precisely what you asked for, yeah? So here you can see that I keep supply constant, yeah? And the demand goes up. So when the demand goes up, when the demand goes up with the same supply curve, the price goes up. And when there is a same demand, but there's a change in the supply, so there is supply contraction. Contraction means reduction. So here, for the same supply, demand curve increases. And as a result, the price increases. Given the supply, when demand increases, price will go up. And here, it's opposite. Given the demand, when the supply reduces, supply price will go up. On the other hand, given the demand, when the supply shrinks, the price goes up. And here you can see this is combined, that there is shift in the demand, there is shift in the supply. So this was demand curve, this was supply curve, A was the equilibrium point, yeah? But now there's some disturbances, there's some disruption in the economy. Demand increases, supply contracts, supply shrinks, and the new equilibrium is B. And at B, you can see that the price has increased than before. So there are possibilities, multiple possibilities. Yeah, that's the minimum and the maximum I think we discussed already, so I will not go into that. This is the situation when there is this is the equilibrium price, which changes every second. Did I show you this picture before? No? This is the stock price. Actually, this is the market price of FTSE 100. I mean, this is the value of the index. All right, and which is changing. You can see here, after every now and then, and you can see that the price, these all are equilibrium prices. So basically I can say that you can draw a demand curve and supply curve on each of these points. So wait a sec. Let's say we have Marks and Spencer stock price, yeah? And we start the market at 9 a.m. and the market closes at 4 p.m. This is the starting price, this is the closing price. Okay, but can you see something? The price has been going up and down all the day. every few seconds? I would show you because the markets in Britain have not started yet. Maybe I try, if I can say, if I could see the yesterday's price, maybe. And here you could see that the prices are going up and down every few seconds. I can draw infinite number of demand and supply curves here. Can you see the crosses? These are basically demand and supply curve. So the equilibrium is shifting. Sometimes there are more buyers and less sellers. Sometimes there are less buyers and more sellers, the price go down. Sometimes the buyer and sellers all are more. Sometimes buyers and sellers both are less. So price keeps changing every second. This is you can draw, if you can draw, you can draw infinite crosses on this line, on this blue line. So this is a real life example of price mechanism. And this price mechanism doesn't happen after every year or after every month. You can notice it after every second. Maybe on one of the Tuesday lecture, I would take you to the stock market and would show you that how the prices are changing after every few seconds. After every few seconds. It means new equilibrium is established. Okay. Before I come to you, can I ask you, should we have the maximum and the minimum price here? Do you have the maximum and the minimum price in the stock market? No, no. Here is the priority. If this was not the stock market, but the food market, the essential food, right? The essential food, then the government would have come in the picture if price was too high or too low. But because the government is aware that who are investing in the stock markets, people who are quite rich, their kitchen is full, the grocery, they have, the fridge is full, they have a lot to eat, okay? They have some surplus money to invest in the capital market. So there is no need for the state to come in the picture. So that's why there's no maximum or the minimum price here. So you can see that the price movement is freely allowed. So maybe this is the best example of 24 karat price mechanism, the purest of the pure price mechanism, where there's no, absolutely no intervention by anybody. There can be some inside trading, there can be some things winding up, but visibly, there's no way the state is coming in action. You have a question, actually. I'm sorry, you had a question as well. Sorry, I ignored you.
Yeah,
unfortunately.
Regulations and so on. I was thinking, is that what's going on in Chile right now? Because people went to the States because they raised the bus ticket price.
Yes. Yeah.
Doesn't have any regulations or so. Is it like free market economy that the price can go up?
Because if you see the bus ticket, the bus is a public service. It's a public utility. Okay. So you can say that it's consumed by masses. Nobody would come in the street if the luxury brand of Ferrari, well, Ferrari itself is very luxury, but any BMW or all these luxury brands of car. Have you ever seen people protesting because iPhone has become expensive? Huh? Hopefully not, because it's a luxury product. It's consumed by classes, not by masses. But there are some products which are consumed by masses. Like you said in Chile about this, the bus ticket. Yes. And a few years ago, not many, I think it's 4 years ago, the students in Britain were in streets, not in street, but streets, because the fee was increased. If you're a foreign student in Britain, you pay more. And if you're a local student, you pay very less. But the local fee was also raised. And as a result, there were near riots in Britain because students were not willing to pay. They were saying that, hey, we come from not very privileged background and Why should we pay more? There was a big rise in the fee at that time for the local students, and they were so upset. Now here, education is a mass product once again. So when those things which are consumed by masses, when their price is increasing, then it comes to a point when people are protesting.
Don't they have any regulations? That's what I'm saying. Don't they restrict the price when it's up there?
Well, there is no, in many occasions, there are no predefined regulations. Sometimes the state acts as a reactively. Now, what will happen after a few days if the protests go on? Then the state would negotiate with the student leaders, the consumer leaders, that all right, okay, let's fix a price, no more increase. So it's negotiable. In many cases, you don't have the readily available solutions. So this is more like a political decision rather than economic decision. So sometime, well, end of the day, this protest will end at some stage. And the idea would be that they negotiate, all right, let's fix the price this much, not beyond this level, and goes on. But definitely the new price would be higher than the previous price for sure. You have a question as well.
Are there any rules of changing? I mean, can we forecast the change?
You can forecast here.
I guess the price may depend on the change of mood, office hours, demand for certain time of the day, things like that.
Remember, this is when I say the price is changing every second, I'm talking about the stock market, the share prices. You know, stock exchange, where people trade shares. I'm talking in that context. So in the stock market, in the share market, the price can change every second because people are very actively buying and selling those shares.
I mean, can we forecast?
We do forecast. If you go to, it's too early for you to tell, but for me to tell, but if you go to thesis.fi, you will see many theses which I supervised, and the students have done forecasting of the prices, the forecast price. Yeah. We have a student from Vietnam, he did last year, graduated, Dan Tuan. He did exactly the same thing, that he forecasted the prices in the Finnish stock market. So he was forecasting already that, okay, this should be the price, and then comparing the actual with the forecasted. Yeah. When you study more finance, you will study more forecasting techniques. Yeah, but you're right, you can forecast. But are you convinced with my argument that, first of all, as this lady pointed out, that was a very valid point, that equilibrium price is not forever. This price is for last many years, 15, 16, 17, 18, 2019. And the price has been changing. Yeah. Actually, it would be even better if I show you. So if you are on this page, yahoo.co.uk, and if I click, for example, BP, you know BP? BP oil company, you know that? British Petroleum. And you can hear that, you can see here that it's not today's price, it's yesterday's. That yesterday when the market started at 9 o'clock, this was the price of BP's share. And between 9 to 10, the price was showing some kind of downward trend. And then around 10:30, there was a spike in the price, which went very high. And between 11 to 2 o'clock, the price was nearly stable, almost stable. But then towards the end of around 3 o'clock or something, the price went down, and which nearly stabilized around 4 o'clock. But basically, during the middle of the day, the price was quite high, you know, there was a rise in the price, but towards the end of the day, the price was going down. Now here, if I only focus on this line, this green top, the summit, the peak of this green trajectory, I can draw maybe a few thousands of demand and supply curve. Okay, when the stock price went up around 10 o'clock to 11 o'clock, it could be because there were more buyers, it could be because there were few sellers, or it could be because there were more buyers and few sellers. And when the price went down around 2 o'clock to 3 o'clock, it could be because there were many sellers and few buyers, or both. Okay, and here it was like more like a normal trading that every buyer was matching with the seller. Here, the buyers were waiting for the sellers. Here, sellers were waiting for the buyers. But here, it was a tight kind of compatibility between buyers and sellers. The point I'm trying to make here is that this is the example where we can see the price mechanism in action uninterruptedly without any problem. This is how the price mechanism comes in the picture. Of course, here there's no maximum price, there's no minimum price, because stock market is more or less a free market phenomena. All right. We study for 5 more minutes because I didn't give you break today. So then we can have an early conclusion. Is it fine? Because if I give you break now, then 10:30 we are finishing. So what's the point of that? Okay. Something more which I want to share with you is this thing here. In one of the exam questions, I would be giving you a piece of news. Snippet. You know snippet? Snippet is a brief cutting of a newspaper, small news. So I would give you some small snippet here. And then you have to make some interpretation of it. And sometimes I can ask you that make interpretation in the context of demand and supply. For example, this is a very old case, but it happened that I think it was 5, 6, 7 years ago. The Russian ruble has lost 25% of its value. That sounds awful and indeed could cause Russia problems. Some economists, though, reckon that weaker ruble can be good for Russian exports. And this is the question I gave to one of my previous year's batches. I don't remember, 2015, 16, I don't know. But this was a question I asked them. And I asked them that make this interpretation with the help of demand and supply. And the answer was that I'll give some answers to you. Demand for foreign currency in Russia is rising, and that of ruble is falling. Supply of foreign currency in Russia is falling, and that of ruble is rising. Russian imports will fall, Russian exports will rise. Now I want you that for next 5 minutes, only look at point 1. Point 1, news item, and point 1, the cause and effect explanation. So study this part and this part. And please tell me, can you explain this problem with the help of demand and supply curve, basically? Can you see this problem? And you can explain this phenomena with the help of demand and supply. much is between ruble and euro today? Any idea? So if I say this is euro 1 in terms of ruble, yeah? So you said that euro 1 is equal to ruble. How many? 71. 71, yeah, sorry, 71. When ruble loses its value against euro, this number would be more or less for 1 euro. So when I say that Russian ruble has lost 25%, will this number be more than 71 or less? More, right? It means you pay more rubles to get 1 euro. Does it make sense? So 25%, 72, let's say it's 71, so around 89, I think, yeah. When this thing happens, who would be very angry in Russia? Who would be angry in Russia? So basically, we're trying to say that if this is 71, let's say euro 1 is equal to ruble 71, how can ruble can go to 89? Well, ruble can be 89 if the demand for euro increases. I can draw with the other color so that we can distinguish between the colors. So when ruble is 89, then if the demand for euro in Russia has gone up, that's why ruble has become expensive, or supply of euros have gone down. So basically this is the supply curve. So this is new supply curve of euros, and this is a new demand curve for euros. This used to be the equilibrium, the red, where is red thingy? This was the previous equilibrium, and this is the new equilibrium. Demand supply equal here, demand supply equal here, but equilibrium is changing over time. So you can explain, here I could explain this actual phenomena by drawing the demand curve and supply curve. Ruble was 71, lost value 25%, so approximately 89. It means the price go up here. You have to pay more rubles to get 1 more euro, to get 1 euro. It means that this is only possible if demand for euros have increased or supply of euros has decreased, or both. I showed both in this case. Now what happened? My question to you is that I have two questions. One I already answered. Can you explain this phenomena with the help of demand curve and supply curve? Yes, we can. I did for you. And for the other questions, you will do it by yourself. Next thing, who's happy, who's angry with this new situation? Fantastic. So if you're a Russian exporter, if you're an exporter in Russia, you should be very happy, isn't it? Because you export to Finland, and for each euro, you are getting 71 rubles before. Now you get 89 for doing nothing. Your 25% profit have gone up, isn't it? But if you are a student, you have to pay the fee. Or if you're an importer, you are a consumer in Russia, buying imported goods from Euro zone, you would be very upset. So it means that the price mechanism is favoring somebody, or it's like harming the other group of people. That's my point here. All right. So are you fine with this? So I would give you some news clippings the business news, and then you try to explain that business news with the help of demand curve and supply curve. Right? I shouldn't say demand curve and supply curve. I should say more precisely, you will show that piece of news with the help of price mechanism or the market mechanism. This is price mechanism or market mechanism. And then find out that who is the net sufferer and who is the net gainer of this arrangement. Okay? I can quickly, well, we will do some next time. I don't think I should bombard you too much today. Okay? Once again, I'm assuming, because I'm not asking any questions to you, I'm not evaluating you, so I assume that everything is fine. Okay? I hope it's true. Thank you so much.